If you're giving up on buying because everything in your city costs $400,000, I need for you to hear this. 20 minutes outside of the edge of the city, prices fall off a cliff. And waiting out there is the only mortgage in America besides a VA loan that finances 100% of the house. Zero down, not a gimmick, and you don't have to be a veteran. Almost nobody checks whether they qualify because of one word sitting in the program's name, rural. And that word is doing enormous damage because the map, it actually points at covers roughly 97% of the land in this country. And about 1 in 3 Americans already lives inside of it. I'm a licensed mortgage loan officer, 20 years, thousands of closings, and I've watched more people leave this program on the table than any other. Not because they didn't qualify, because they never looked. So today, we're getting all of it. The USDA loan, what it saves you exactly what you need to qualify. And the real catches, because there are real ones, and they're not the ones the internet talks about. Let's go. Start with what this actually is, because the name throws everybody. USDA is the Department of Agriculture, the farm people. And no, you don't have to farm anything. Here's the mechanic, and it's the same trick FHA runs. You don't borrow from the government. You borrow from a normal lender or a loan officer like me, and the government guarantees the loan. It turns to that lender and says, if the borrower stops paying, we cover the loss. That's the entire reason a lender will go to 100% financing without blinking. It is being generous. It just isn't carrying the risk alone. Real quick, right as this lands, if the government guarantees the lender, not you, just rearrange something in your head. Do me one favor, tap the like button. It's free. It takes a second. And on this channel, the size isn't the whole difference between this reaching the next renter who thinks they're priced out for good. And subscribe if you want more of these videos. Okay, let's talk about what moving 20 minutes actually does. One quick note before the numbers start. I'm a licensed loan officer, but this is education, not personalized advice for your file. Rates move, the fees get reset every October, the income limits change every single year, and your counties may not match mine. Treat my numbers as clean, round numbers and examples. The shape is right. The version lands a little bit different. So let's put a real price on what 20 minutes, because I don't think people understand how violent the difference is. Say the house actually that you want in the metro area is $400,000. FHA is your best store there. 3.5%, $14,000 down payment, and closing costs are around $12,000. And you need about $26,000 in the bank before anybody talks to you. Your payment on that house all in is about $32.62 a month. Now go 20 minutes further out into the USDA zone and buy a $250,000 house, zero down, closing costs that, as you'll see in a minute, can legally end up at nothing. Your payment there is about $2,045 a month. Sit with that. That's about $1,217 a month cheaper, over $14,400 a year, and roughly $26,000 less than you needed to save to even start. Same use, same job, same credit. The only thing that changed is the zip code and a commute. That is actually trade. That is the actual trade the market is offering right now. And most people never price it because they assume the loan out there is worse. It isn't. It's better. Benefit number one, and it's the headline, is zero down. Not 3%, not 3.5%, zero. USDA finances 100% of the purchase price. And there are exactly 2 loans in America American lending that do that. It's this one here and a VA loan. VA, however, needs military service. This one needs an address and income under a cap. That's the whole difference. On that $250,000 house, 20% down is $50,000. 3.5%, the FHA door is $8,750. USDA is zero. And for most people watching this, the down payment was never the hard part of wanting a house. It was the only part. Benefit number two, and this is the one that quietly beats every other program. The mortgage insurance is the cheapest on the board. Anytime you put less than 20% down, you're paying somebody to cover the lender. On FHA, that's 1.75 upfront, about 0.55 a year. On USDA, it's 1% upfront, 0.35 a year. I'll read that again. USDA lets you put nothing down and charges you less for the privilege than FHA charges you to put 3.5% down. On our house, that's $113 a month of FHA insurance versus $74 for USDA. And USDA fee is calculated on your average balance for the year. So as you pay the loan down, the number quietly shrinks every single year. FHA's doesn't work like that. Benefit three, and this is one genuinely strange the first time you see it. You can walk into a closing having spent nothing. Zero down covers the down payment. It does not cover closing costs. Those still exist, and on this house, they'd run around $7,500. But you've got three ways to make that number disappear. One, the seller can pay up to 6% of their price towards them, which is $15,000 of room, twice what you really need. Two, family can gift you the money. They can gift all of it. And three, the one nobody knows. If the house appraises for more than you agreed to pay, USDA lets you finance closing costs into the loan up to that appraised value. So if you go under contract at $250,000 and it appraises for $258,000, that $8,000 of room can swallow your closing costs whole. So let's actually run it because the whole thing gets obvious with real numbers on the screen. $250,000 for the house, zero down. So your loan balance is the full $250,000. USDA charges that 1% guarantee fee upfront, which is $2,500. And almost everybody rolls it into the loan instead of paying it at the table. So your actual loan is $252,500. At today's rates, we're going to call them roughly 6.5%. Just for purposes, your principal and interest is about $1,596 a month. Then the annual fee, about $74 a month in year one. Property taxes, let's call them $229. Homeowners insurance, about $146. And add it up, and your all-in payment is about $2,045. With cash to close, that can land very close to zero. Real quick, today's video is brought to you by me. No big sponsor, just me. I'm a licensed mortgage loan officer. And if you're buying in the next few months, this is what I do all day. Call me for a pre-approval. So book a free 15-minute call, no pressure, no pitch. I'll run your real numbers and check your address against the map. Want to run it yourself first? That's fine. My free USDA payment calculator link down there below too. Scan the code or tap the link in the description. Now let's get back to it. You should be asking whether zero down costs you more monthly, and that's a fair question. So here are the three doors on the same house. USDA is zero down, $2,045 a month. FHA, $8,750 down, $2,040 a month. Conventional, 5% down, which is $12,500 with a mid-600s credit score. Your PMI prices off the score, which is about $2,058 a month. Look at what that says. FHA beats USDA by $5. and charges you $8,750 up front to do it. You need well over a century to break even. And conventional with the biggest down payment of the three is the most expensive payment of the three. If your credit is in the mid 600s and your address qualifies, USDA isn't the compromise option, it's the best one. Okay, here's the first real catch, and it's the one that knocks most people out. There's an income cap. The limit is 115% of the median income where you're buying. In a typical county, that's around $119,850 for a household of 1 to 4 people, and around $158,250 for a household of 5 to 8 people. Expensive counties run higher. Now, here's the part that blindsides people. The rule says annual income is the income of all household members. And then it adds 5 words at the end, regardless of whether they're on the note. Read that again. Every adult living in the house counts, whether they're on the loan or not. Your girlfriend isn't on the mortgage, her income still counts if she's living in the house. Your 22-year-old who lives at home and works counts. Your mother-in-law's Social Security counts. And your assets get counted too, not just your paychecks. I've seen deals die 3 weeks in over an adult nobody thought to mention. Tell your loan officer who is actually moving into the house on day 1, not day 30. Now the map. And I want you to reframe this because everybody treats it as the limitation, and it's actually the whole opportunity. USDA has a map, and it's free, it's public. You type in an address, and it tells you yes or no in about 4 seconds. Roughly 97% of the land in this country sits inside of the eligible boundary, and about 1 in 3 Americans lives in a spot that qualifies right now. Generally, it's towns under 35,000 people, plus everything outside the town's lines. What that means in practice is that the outer ring of most metro areas qualifies. Not downtown, not the inner suburbs, but the newer subdivisions 15 to 20 minutes past the last exit very often are a yes. And that is exactly where affordability inventory is right now. And that is exactly where affordable inventory is right now. So the geography isn't the price of admission. The geography is the discount. You're not settling for a worse area. You're getting the cheaper house and the cheaper loan in the same move. One heads up, the maps get redrawn, and an area that qualified 5 years ago can be off the list today. Check the map, not your memory. And out there, if your area loses its designation while you're already under contract, the rules do have a path to honor that. And out here, the appraiser is looking at the things a city appraiser never thinks about. So know these before you fall in love with the listing. The site has to be modest and typical for the area. It cannot include income-producing land or buildings, vacant land, a working farm, acreage used for agriculture or commercial enterprise. Those are ineligible. No-go. You can have land, you just can't have business growing on it. The property has to have direct access from a hard surface, all-weather road. And if that road is private, there has to be a legally enforced agreement about who maintains that road. That kills more country deals than you'd think. And the water and the septic have to be adequate, safe, and up to code. A private well and a septic are fine. They just have to actually pass. Then the smaller rules. I'd rather you hear now than 3 weeks into the contract. It has to be your primary residence. 1 unit only. This is not the house hacking loan. FHA will do a duplex at 3.5% down. USDA will not. Everybody on the loan has to live in the house. So there's never a non-occupant cosigner the way FHA allows. There's no cash out refinance. And there's a rule people find strange. You have to be unable to get a conventional loan on reasonable terms. This is a program for people the normal market won't serve well. And if you can comfortably do a conventional loan, that's the door that you need to be in. On credit, USDA publishes no credit score, but the automated system that approves these wants to see around the 640. And below that, you're into a manual underwrite with much shorter list of lenders. On ratios, the guideline is 29% for the house payment and 41% for all debt. And the rule book isn't names. And the rule book itself names a 680 credit score as a reason to go above that. So, how do you actually beat the income cap? 3 ways. Almost nobody uses. First, the number they measure is not your gross pay, it's the adjusted income, and there's a list of subtractions. There's a deduction for every household member besides you and your spouse who's under 18 for a full-time student or an adult with disability. Childcare for a kid 12 or under counts, as long as it lets somebody work or go to school, and the sitter isn't someone living in the house. And for your elderly or disabled households, medical costs above 3% of income come off too. I'm deliberately not quoting you a dollar figure on that dependent deduction because it's tied to a HUD number that gets adjusted. And half the articles online are quoting a stale one. Your loan officer pulls the current figure second, and this trips up good loan officers. There are 2 completely different income calculations running on your file at once. One is the household income, decides whether you're eligible and counts everybody. Repayment income decides how much house you get and only counts people on the loan. So an adult in your house can push you over the line without helping you qualify a dollar. But flip that around and it's a tool. If your income alone is short, the rules let you add an eligible household member to the loan to strengthen the repayment ability. They were already being counted against you. You might as well put them on and get the credit. Now the stuff nobody puts in the USDA videos. 4 things that live in the rule book and never make the conversation. Number 1, there's no loan limit on this program. FHA caps you by county. USDA doesn't publish a maximum loan amount at all. Your ceiling is just what your income supports. Number 2, there's no first-time homebuyer requirement, and current homeowners aren't automatically out either. If your current house generally no longer fits your needs, there's a specific path to use this again. Number 3, there's a streamlined assist refinance built in. If rates come down, you can refinance an existing USDA loan into a lower one, typically with no appraisal and no credit qualifying. And number 4, these loans are assumable. But let me give you the honest version because most videos stop at the good part. A qualified buyer can take over your loan, and the rate they get can't exceed the rate on your original loan. That's real, and it's valuable if rates are higher when you sell, but it needs agency approval. That buyer has to meet every eligible rule, including the income cap. There's a new guarantee fee, and here's the one nobody mentions. Unless you're released, you can remain personal liable on that debt after they take it over. So it's a genuine selling feature. It is not a walk away. One more thing worth knowing. Everything I've described is the guaranteed program. what you get from me or any other normal lender. There's a second one, a direct loan that comes from USDA itself. It's for lower incomes under 80% of the median income instead of 115%. And it has no guarantee fee at all, longer terms, and a payment subsidy that can push your effective rate down as low as 1%, depending on your income. The trade-off is a longer line, tighter rules, and part of that subsidy gets paid back when you sell. If you're on the lower end of the income scale, ask for it by its name, because a lot of loan officers won't bring it up. Which brings me to the myths, and there are 3 I want dead. Myth 1 is for farms. No, it's a residential loan, regular house, and a farm is the one thing that disqualifies the property. Myth 2, it takes forever. It used to be slower, and the government's funding calendar can add a step, but a guaranteed USDA loan through a lender who does them regularly closes on normal timelines. Myth 3, it's the loan you settle for. You just watched it beat both doors on the same house with none of your money in it. That's not a settle for. So here's what it's actually for. This is the screenshot moment. Grab it. If your household income is under $119,850 for a family of 4, check the math today. If you've been priced out of your metro, you'd consider 20 minutes further out, check the math today. That one decision was worth $1,200 a month in our example. If your credit is 640 or better and the down payment is the only thing standing between you and the house, this is very likely your loan. But if you're set on the city, or your household clears the cap, or you want 2 to 4 units, this isn't the program. FHA or conventional is where you should look. And whatever door you walk through, the bank will approve you for a bigger payment than you should ever actually accept. Pick the loan for your situation. Pick the price for your life. Here's what I want you to take away. Most people never use this loan for one reason. The word rural made them stop reading. So they never learned the map was drawn around almost the entire country. And they kept fighting for a $400,000 house when a $250,000 house is a better loan on it. Was 20 minutes away with the whole time. It's not telling you to move somewhere you'll hate. I'm telling you to price it honestly before you decide you can't buy it at all. Checking your address takes 4 seconds and it costs you nothing. Go do it. And if it comes back green, you are a lot closer to the front door than you were when this video started. I'll see you in the next one.